This episode of From Angel to Exit is brought to you by the CEO's Right Hand. The CEO's Right Hand provides customized outsourced finance, accounting, and human resource services tailored to small and medium-sized businesses. Their services include fractional CFO, HR support, capital raising, and financial infrastructure development. They emphasize personalized engagements and expert support to drive growth and operational efficiencies. If you want to find out more, visit theceosrighthand.co. Are you serious about planning a successful business exit? From Angel to Exit is your go-to resource. Subscribe to our newsletter at eckfeldt.com/podcast for even more valuable insights. And to get personalized guidance, take our free exit readiness assessment. It's just 24 questions, and it will give you a clear picture of your exit readiness. Find the assessment at eckfeldt.com/exit. Submit your results, and we'll schedule a free follow-up call to discuss your specific situation and the best way to maximize your valuation and ensure a successful transaction. Now, back to the episode. Welcome, everyone, to From Angel to Exit. I'm Bruce Eckfeldt. I'm your host. Our guest today is Mital Makadia, and she is a partner at Grellas Shah. We're going to talk a little bit about MA environment. We're going to talk about exits. We're going to talk about earnouts. I'm excited for this. I'm always excited to talk with people who have been through this or have seen many transactions. It's a chance to kind of talk about patterns, trends, things like that. And so I'm excited about kind of the conversation and where some of the insights are. Hopefully some of the folks listening to this that are earlier in this process looking to scale and ultimately exit some of their companies will get a couple, hopefully, nuggets, a couple takeaways, help them really kind of think more strategically about what does this journey look like? What does this process look like? And what do they do after? So with all that, Mital, welcome to the program.
Thank you. Thank you for having me. It's nice to meet you.
Yeah, likewise. So before we dig into kind of the world of exits and earnouts and transactions, would love to get a little background. How did, I guess professionally, what was your background? How do you get into the space? Give us a little of the story.
Yeah, sure. I was a young lawyer on the East Coast, and I went straight into the corporate law at the big firms in New York. I did that for about 5 years, that and in DC. I did mostly public company securities work and IPO work. But then I transitioned out here to the West Coast, and for the last 15 years, I've been doing general corporate work, but for the startup space. And so not as much public company work, but definitely the early stage startups. So I've been practicing law for over 20 years now, and the last 15 of them squarely focused on the startup space, which is very exciting, especially here in the Bay Area.
Yeah. Give us a little contrast. I mean, what has been interesting about getting into more of the startup space from the public area?
Sure.
What have been some of the challenges? Love to just kind of get your take on it.
The best part about this is working with founders and entrepreneurs directly, right? When I'm doing public company securities work at the larger firms on the East Coast, my clients are, the vice president of so-and-so at that level. And I mean, we do deal with the CEO and the founders, but very rarely. They're pretty much gone by then. It's even the early investors are gone by then. And it's a completely different makeup of owners. But here, you've got the passionate entrepreneurs that you're dealing with, and the struggles that they're dealing with. And when they win and when they make it, that's much more rewarding and exciting for us. And in terms of the struggles with working with early stage startups, really it's the money, trying to get the funding, trying to survive. And we see a lot of startups that don't make it, and that's always sad because we've been on that journey with them from the beginning. And there's always the next venture, but it is sad when that first passionate project dies. But hopefully that's not what we're talking about here. We're talking about clients that make it. I was going to say, for me, most of my clients, if they make it, it's between the A and the C round. And when they make it between the A and the C round, that's when they get, significant chunk of money. They haven't been diluted as much. They get life-changing money. And that's always exciting.
Yeah, I mean, I guess do you have any kind of rules of thumbs about number of companies that don't make it or a number of companies that have a successful?
That would keep me up at night if I kept the metrics. I try not to think about that. It's hard to put a number on that. I would say it's an easier metric to determine which companies make it once they've got outside funding. Because a lot of companies don't make it, to the
Never
Series
make it to
A.
outside
Yeah,
funding.
yeah. And I think that's tough to track. But once they get that Series A, that's an easier track. Yeah. And then those situations.
And when do you typically start working with them at that Series A point?
No, the clients come to us pretty much at incorporation, or right after their Series A. So that's pretty much the window when we get them, and we take them through the various funding rounds, A, B, C, D. Beyond D, I would say they outgrow us. They're on their way to IPO, and we're not scaled for that. But we're pretty mid-market in terms of our valuations. So anything less than $1 billion in valuation, that's sort of our sweet spot. And then when the M&A work as well. But
what and how? I mean, everyone kind of has their own definitions of what these rounds, represent or what they mean or what they are in terms of size. How do you kind of define, A, B, C, D in terms of, stages of growth or kind of pivot points or transition points for companies?
Sure. Yeah. It's, there are a lot of VCs that are doing the early stage, almost angel investing type. They're calling it Series Seed, but it's not really. I would say once they hit like 5 million ARR and they get that round, that's pretty much a proper Series A, if not more. But I was going to answer
what are they using it for? Like, is that why raise the A? Like, what is it there? Like, what's that inflection point in terms of change of strategy or change of focus? Like, now that they've got a Series A, what does it allow them to do?
Scale, mostly. Yeah. It gets them over that hump and really scale. But I was going to answer your earlier question, when you said how many of them make it. Once they get that Series A, I think the majority of them make it. And it depends on how you define making it, right? Yeah. You see a lot of LinkedIn posts of so-and-so being acquired by so-and-so, but really what were the terms of that? But generally speaking, they'll land somewhere. It might not be where, they wanted to land. It might not be where the early option holders or common stockholders really get much of anything. But somebody will buy them. They will find a home generally somewhere.
Yeah. They'll land.
They'll land. Yeah.
They'll land somewhere. Yeah.
Or at least a place where they can, do their next venture from. Like they've gained some insight, they've gained some experience, and they're better at it in the next venture.
Yeah. And when you look at sort of B, C, and D, is this just ongoing growth, or is there kind of pivot points like that come into play, like in terms of what they're focused on, or change of leadership or change of strategy? Like, is there anything that you look at when you look at these other funding rounds?
Yeah. C is the real growth round, right? That's, A helps them scale. B is, I don't know how would define a B, but they're doing well. B is they're doing well. But C is really when they're going global.
Yeah. So it's a major expense. They've kind of proven their model. They've got leadership in place. Systems are more or less working. They've proven the financial
those investors aren't really involved with the company in the same way that the Series A and the Series B investors are. The Series A and Series B investors are like rolling up their sleeves and really.
Yeah. So they're intimately involved with leadership, with strategy, with recruiting, with building up teams.
They're very helpful.
Kind of approach. Yeah.
C is the money.
Whereas C is basically I have a really big checkbook.
Exactly.
And let's just fuel this thing and get it to the next stage and then cash out.
Exactly.
Okay. In terms of the types of transactions, I mean, you mentioned a couple of different scenarios where they're getting bought by another company, or they're doing another round of funding, or they get tucked into something. Like, what are some of the typical paths that you see in terms of situations that founders find themselves in, or possible scenarios that they start to think about once they get a first round of funding?
Yeah, typically it's a strategic buyer, right? You never know where those buyers come from. It could be somebody you didn't even think was a buyer, maybe some customer of yours, large customer of yours. But yes, typically it's a strategic buyer that'll come in.
Yeah, and just for audience clarification, strategic meaning that it's not just, hey, I see a financial return on putting money into this company. There's some kind of underlying asset or capability or something that I can leverage in a unique way and combine with my existing business or kind of create something that's synergistically more valuable than the entities on themselves.
Correct.
Yeah. When you're working with founders on this, when do you start talking about what those paths, talking about those paths and which path they might most likely end up down, in terms of just planning for the future and things like that? Like when does this discussion come up and what does it look like?
Usually when they're tired. Depends.
They're exhausted
Depends
and
how much
they're throwing in
energy.
towels.
Yeah, it depends how much what's going on in their life and how much energy they have to get over the next hump. I mean, the pandemic changed things a lot for people, right? There's a lot of people that raised money that maybe should not have been funded. So there was a lot of my clients. There's been a lot of M&A in the last 2 years, and a lot of that is because clients raised money, and it was easy money right after, in 2021, 2022, but then couldn't. The environment wasn't there for raising additional funds in 2024.
Yeah.
And so they had to figure out how to, because they're reaching the end of their runway, and then they had to figure out how to sell.
Yeah, I would love to talk about that a little bit, because so when you say, post-pandemic, easy money, right, funded that shouldn't have been funded, like is this just a supply and demand? Like money was just looking for a home, and they were willing to fund things that maybe weren't the most.
Not for everyone, obviously, but or maybe at higher valuations than was warranted.
Okay,
yeah.
So I always find this one interesting, because I think a lot of founders, or there's kind of there's definitely a thinking of like, oh, I should get the highest valuation that I possibly can every single time, and I've certainly seen lots of these situations where people do an early stage at a very high valuation, and then they're kind of boxed in.
They are boxed in. There's a lot of
tell me why this is a problem, or how does this affect kind of future rounds, or what are the dynamics around?
Because it sends a signal as to what your company should have been to earn that valuation, right? What should have been the size of your team, the revenue numbers that you're pulling in, the customer metrics. If that's not all there, that makes the next round infinitely harder.
So they're kind of ahead of themselves?
Yeah.
Like from a funding point of view, they haven't really caught up operationally and strategically for the funding they've had. So now when the next round comes in, what ends up happening?
Well, if it's ends up being a flat round, then it sends a negative signal to the market. And that's not good for employee morale either. But that first valuation shouldn't have been that high, right?
So can we throw out some numbers? So say you're you do a $2 million round at a $4 million valuation. Then when you go to do your next round, you take on another $2 million, but now you're still at a $4 million valuation. I mean, what would some of the numbers be?
Yeah, the numbers.
In those cases?
No, it would likely be like a 40 million or 60 million valuation. Let's say you raised your Series A at, I would say 40 to 60 million valuation. And then your Series B.
And what are they taking on? A Series A, what are they, like, what's an average raise for Series A?
5 to 10 million, maybe.
Okay.
Yeah. And let's say you're raising your B round and it's coming out to another 60 million valuation. That makes it harder.
Yeah. Because now the existing investors are basically,
because the A shouldn't have been that high. That valuation shouldn't have been that high.
Yeah. A's overpaid. Basically. Yeah. And the fact that they overpaid becomes very transparent on the next round.
Right. And it's bad for morale. It sends a negative signal to your employees, to the investors when they come in and they see that you had raised the prior round at the same valuation. Why are you offering me the same valuation? What's wrong with you? What's wrong with the company? What troubles has it had the last 2 years? Yeah.
So you just haven't really executed on what the plan was.
But to your point, a lot of times at that first the first stage of negotiation, you've got maybe 2 or 3 term sheets that you're playing off of. The instinct is always, okay, go for the one with the highest valuation. But But really go for the best partner you can find. Who's going to
So,
actually
so I
help
was just
you?
going to ask
Yeah.
that. Like, is there a situation where you would say don't take the best valuation?
Oh, yeah.
And it sounds like it's because
Well, definitely
you really
don't
need to
take it
look at who
from
you're
like a
getting in bed with.
strategic investor.
Yeah.
That's always the scariest. I've had clients that took money from a strategic investor, and then that investor really kind of starved them and prevented anyone else from coming in into the next round just so they could
Oh,
scoop them
interesting.
up.
So they take a round and then kind of box out future investors to keep the valuation.
Yeah, I mean, this wouldn't happen with like a traditional, VC in the US, but I've had lots of clients that have taken funding from the venture capital arm of some, Asian corporation.
Yeah.
And not to malign Asian corporations, but
Yeah.
but it's usually a strategic investment, right? There's something
Yeah.
about your IP that they like, and this large foreign public company has a venture capital arm, and they're offering me $5 million. Let's take it. But that $5 million usually comes with certain veto rights, preventing you, or maybe even a ROFR right to buy you. They'll ask for the first rights to buy you in an M&A transaction. And in the beginning, you're not thinking, you're like, oh, well, someone else that, maybe it's a bidding war. Someone will want me. Great. But you're not thinking about what could happen 2 years from now when you've spent that money and you're looking for the next investor, and all of a sudden,
you're under pressure to.
But not just that, all of a sudden this corporation has no interest in you getting additional funding from anyone else because they want your technology.
Or maybe even has alternative.
Yeah.
They're disinterested.
This has very much happened.
Yeah. And how, I guess for, founders that are kind of approaching this, like how do you advise them, or what do you suggest they think about? Because it's complicated, right? Like I'm trying to run a company, I'm trying to build a business, I'm trying to deal with employees. And now I've got this whole okay, well, what are the motives and the intentions of people that are, going to fund me? Like how do you sort through this as an investor or as a founder?
Sure. There's so much money out there right now that your money shouldn't just be money. It should provide something else. It should provide, connections to customers, like you said, help in scaling and growing the business, thinking about being a real partner in all of this with you, because you can get money anywhere.
Yeah.
Yeah.
Well,
I know it's harder. It's easier.
Yeah, exactly. Like people in the money business know that. The people in the founding business don't necessarily realize that. I guess how do you kind of practically balance that? Because yes, I get it. There's lots of money available if you know where to look and you put in the effort and you have the time and patience. But I think most founders would say that unfortunately when they're looking for money,
it's harder.
They're typically looking for money under pressure, right? There's some kind of, I've got 6 months of runway, or I've got this major opportunity that if I can't get a funding round, like I'm going to miss this joint venture or this partnership or this.
Well, that's
big
where
client.
the accelerators come in, right? Like you find a nice, reputable group of people that can help you. There's a lot of people out there that will, promise you the sun and the moon and will take a percentage of whatever amounts that they can help you raise. Like stay away from all that. But find reputable groups that can assist. They're out there.
Yeah, no, and we've talked to a few of them, people on the program. So yeah, it's out there. I think it is always kind of this. This is the challenge of founders, right? Like there's a lot of things, a lot of balls to kind of keep going, but carving out time, having good strategies, understanding the landscape, having good advisors, trusted networks can be super powerful and helpful in sorting through those things. Let's talk a little bit about the M&A side of things. Like when you're, you talk with founders about kind of where is this going? What are the paths? What are the things that you're advising them to do to kind of develop those paths, or, to get them ready, or at least not do things that are going to make it harder on some of those paths? Like are there things you're looking at or helping them with?
There's always diligence, right? And making sure your legal house is in order, your financial house is in order. Make sure you have a good accountant, a good lawyer. Those are those are things that you can address once you get into the M&A. The main thing is, are you going to use a banker? Are you going to use a broker? Or are you going to try to go out there and pound the pavement and find a potential buyer yourself? There's a lot.
What do you recommend? Do you have any
under a certain
or situations?
Under a certain size, don't use a banker. I mean, there's some of them. There's some that can add real value, but generally speaking, you're going to give up a fair chunk of the sale proceeds to eventually find a buyer that was already in your orbit.
Yeah, and this is always. I mean, I don't know where your numbers are. I typically find like under 50 million.
Yeah.
Like it's, a banker. You probably won't find a banker that will work for you under 50.
There's some. They will, but yeah, it's harder.
And the value. I mean, you're not going to be their biggest client, right? Like you end up getting, it's this. It's kind of a no thank you deal, right? And particularly if you're looking at strategics, right? I think a lot of founders don't appreciate. They probably can map out, a pretty good list of potential acquirers.
Yeah.
That
they weren't even thinking, but they're literally in their orbit. Yeah.
Yeah. They're competitors, they're partners, they're suppliers, they're customers, right? Like, I've done a couple exercises with these companies, and all of a sudden we come up with a list of a dozen people who are like, we should be talking to them at some level. Now, we may not, be sending them emails of saying, hey, do you want to buy us? But there might be ways of starting to develop relationships and explore some of this stuff earlier.
As a founder, it's always good to keep those relationships warm, even from the very beginning. Just check in with them, make sure they know who you are. You might not even want to sell for the next 5 years, but from the beginning, keep those lines of communication open because you never know.
Yeah. Is there anything that you would say founders should look for in some of those relationships? Is it strategic fit? Is it, market opportunity? Is it complementary services?
It's going to be the terms. Because once you sell the company, I mean, I don't know about your experience, Bruce, but in my experience, once you're an entrepreneur, you're an entrepreneur. You're not going to, as much as you think, this product that you've built is so amazing and it's going to do wonderful things inside this large corporation, your heart's not going to be in it. It's not yours once you sell it. And you're going to want to get out. No matter how much, incentive there is for you to stay. They could put in a 4-year vesting term. They can do that. But I was going to say I used to keep an internal list of how long my founders last post-closing. And my record was like 3 months, I think. Somebody lasted 3 months.
Wow.
But then I beat my record, and I don't think I will ever beat it again. Because I did an M&A, it was in February of, I think 2 years ago, and the deal closed on Thursday. And I remember the exact moment I was hiking in San Francisco in Twin Peaks. It was Saturday or Sunday that day. I get a call. I can't do it. I'm leaving. And it was because, I'll tell you this, it was because his team couldn't get cell phones. Like their cell phone plans wouldn't be paid by the buyer anymore. Yep. And he just couldn't take that
policy.
Yeah, I mean, he made enough money; he could have paid it himself. But it was the insult of having to answer to somebody, and all of a sudden you're working for somebody, and their HR rep is telling you what you can and can't do with your team. Yeah.
I generally say most entrepreneurs are unemployable.
Yeah.
Right. Yeah. Like you can't. I mean, what made you a great entrepreneur makes you a horrible employee.
But I don't think anyone's going to beat my 3-day record. I mean, that record is there. And there was incentive for him to stay because there was additional money. It wasn't like he was walking away from real money.
About the money. It's not about the money. Yeah. So let's talk about it because I think this is where I just find it fascinating. It's where kind of psychology versus logic versus kind of future vision kind of come into play. Oftentimes these deals come with some kind of, earnout or, ongoing role. And I kind of break it out into, your money, you've got your cash out transaction, right? What you're going to get on the transaction date. Then you've got deferred payments, which could be, fixed notes, right? About ongoing payments that aren't tied to kind of performance or anything, they're typically at risk because they're backed by the company and things like that. But the ongoing payments. Then you've got earnouts, which are often performance based, as some
or revenue,
either specifically or
milestone
revenue,
or revenue,
property performance, individual performance, and then you've got executive packages, right? So sometimes these founders stay on in some executive role that has a significant salary, maybe has its own performance, bonus and compensation associated with it and stuff. How do you help sort through these kind of things with founders as they're kind of getting these offers and comparing different term sheets and stuff?
Sure. Let's take them separately, right? Salary, it is what it is. As long as are you happy with it? As long as you stay, you'll earn it. If you're not happy, you'll walk away. You won't have it. Are you okay with that? The one that's more difficult is when a portion of their actual sale proceeds is held back subject to vesting, right? So it's not quite an earnout, but they're basically earning out their sale proceeds. And it's only time-based. As long as they stay employed, they get their full sale proceeds. That one's always an easy one. Make sure you get acceleration. Full single trigger acceleration if you're terminated without cause.
Okay. So terminated without cause.
If you're terminated without cause.
Automatically accelerate. All payments due on that.
Including, resignation for good reason. Those two kind of go hand in hand.
So tell me, what is resignation for good reason? Like, how would you actually define that?
So it's usually like a reduction in salary or role. Like, let's say I get acquired by Google or Apple, and I have an acceleration clause so that if they terminate me without cause, I get my full sale proceeds. But if I don't have a corresponding good reason, they could make me be the janitor at their facility in Alaska. They haven't technically terminated me, right? But it's essentially like constructive termination. So in that situation, I would have cause to resign for good reason, and then I would get full acceleration. So you definitely want, any reduction in salary, reduction in your role, or a requirement that you move more than 20 miles from your primary work office. So then you should get full acceleration. But taking out that and the salary, the third bucket you talked about was earnouts. Yeah. Earnouts, I always tell clients, just assume you're never gonna actually get it, right? Exactly. As long as you're okay with that, go for it. But that's not reality. Reality is that earnouts are used to sort of bridge the gap between what the sellers need and what the buyers are willing to pay at the time. So unfortunately, earnouts do factor in too many deals. Even though I advise clients not to count on it, but it is what it is. With earnouts, really you want to focus on two main things. One, do you have full control over your ability to earn that earnout? So after the M&A...
meaning if the earnout's tied to gross margin or revenue growth or...
Are you going to be able to actually keep your team, keep them employed? You're going to end up being a subsidiary of a larger corporation. Are you going to continue to be able to operate and run your business? Sign on the customers you need to sign on, etc. The second one is, are they going to give you the right budget? Because remember, even if your company is just operating on its own inside a larger company, you're no longer the CEO or on the board of that company. Yes, you're running that division, but really the buyer and their, VP of whatever.
They control resources.
They control resources. Are they going to make sure? So two things you got to negotiate in the actual sale agreement, which if you have an earnout, is control over your ability to actually earn this earnout and an actual budget number so that they're required to give you a certain amount that you need to earn this. Resources. And if they don't, like I said, build in that acceleration provision. Make sure.
Yeah, if they change it, if they rescind.
Yeah, because buyers are, they don't want to agree to any language in the purchase agreement that restricts them in any way. They're going to say, well, we need flexibility to run the business. We need to be able to hire and fire people. And, we need to have our budget and do whatever we need to do. Maybe even create a competing product or no longer, focus on this product that we've bought. But that's okay. You can have that flexibility because you need to run your business how you need to run it. But in that case, you need to accelerate me. That has to.
Then you got to pay me out.
They have to pay me out. Yeah, that has to factor into your decision to make whatever business decisions you need to make.
And typically earnouts, or I guess, have you seen earnouts where you don't have roles in the company, where you don't have an operational role, and it's basically just, hey, look, if the company continues to perform, you get the money, but you're not going to have.
I've seen that, but I tell clients, like, just don't count on it.
Then forget
You
it.
know,
Then go
think
off,
of it
like,
as gravy. Like, if it happens, it happens.
If you get a check in the mail,
you get
you'll
the
be
check in the
surprised
mail.
and happy.
Yeah. But, you know, speaking of that, like, at whatever various earnout points you've negotiated, make sure you've also negotiated for information rights. So if at
Okay.
the end of the 12-month mark or 18-month mark, ask to see the financials, or whatever the numbers are, so you can verify yourself whether they've achieved that, or you've achieved that earnout, you know, milestone or not. And make sure there's a dispute mechanism in there, so you have enough. Like,
What would that look like? Is this like an arbitration or a third party?
Yeah, no, not even arbitration. Like actual mechanism built into the purchase agreement, so that you know, they're required to give you periodic. Like, I wouldn't even wait till the 18th. Every quarterly, they're required to give you the metrics for the product sales and whatever you need to verify. So that way you get into the habit of reviewing these, and then you can track progress. And then at the end of the earnout period, you can verify. And you have maybe 60 days to compare the numbers, and audit rights to audit their books, etc. And if your numbers, or if you don't agree with their numbers, then you both have a mechanism for appointing an independent, you know,
finding a third
party. Like, that kind of mechanism can be built into the purchase agreement.
Yeah. How, I mean, this may be a little more conceptual question, but I always find it interesting and oftentimes challenging when you're kind of going through this transaction mode where, I don't know if I'd say it's adversarial, but you both have somewhat competing interests, and you're kind of negotiating against each other, and you're trying to, like, I hate to say it, but you're kind of thinking about all the ways things could go
all the ways they're
wrong,
gonna
and
screw
all the
you.
ways I can get screwed, right? Like, and then you kind of sign this deal, and you're like, okay, great, let's work together. Like, so how do you navigate this a little bit?
It's like signing a prenup before your wedding. Like, it's always gonna leave a bad taste in anyone's mouth. I'm sorry, it is. It's just the reality. And people always walk away with, like, I mean, they eventually land somewhere, but not without battle scars, right? And it takes a lot of maturity on both sides to avoid those sorts of negative feelings. But generally speaking, I tell clients, the most leverage you're ever going to have is before you sign the term sheet. When they're wooing you, they're essentially wooing you. And once you've signed that term sheet, then it's death by 1,000 cuts. Yeah, it really is. And they keep chipping away, and it's, you know, well, our HR rep said this, and, you know, corp dev wants this, but you know, the CEO is different, and the CFO and our general counsel. There's always, in a large company like that, there's always like, well, I believe in, you know, I'm your biggest advocate here at this company, but I need to get it approved by the board. Like, they're professionals. They know what they're doing. The founders, this is the first time they're doing this. So they are going to wear you down, because like I said, once you sign that term sheet, you're picturing the money. You know, you're picturing the end.
Oh, you've already spent it.
Right. You're picturing the end of your 12-hour work days or 14-hour work days or whatever it is. It's really hard to get back into, like, growth mode if this deal falls apart. And so you'll take whatever they give you, even if, gosh, this is the sad part, even if they, you know, halfway through renegotiate the price. And I'm seeing that more and more now. It's really sad, because in my 20 years of doing this, I think I saw more purchase price renegotiations in the last 3-4 years than I have in all my entire career.
Well, so two things. One, you know, my kind of advice to most founders is, you know, the key to happiness is low expectations, right? So just, like, go into this, you know, post signing, like, yes, it's a different world. Just accept all these things. The more you can just accept that things might happen, you know, could happen, might happen, probably will happen in some respects, like, the better off you're going to be, right? The more realistic you're going to be. Two is don't
show weakness, dude. That's the other one. Sorry, I didn't mean to interrupt you. I was going to say, don't show weakness, because they'll smell it.
What's it meaning? What?
It's like they can tell when a founder is desperate and scared that you're going to walk away as a buyer.
So this is the next one I was going to do, which is sort of right. Is I was, and this is hard for venture-backed groups that have, they've got to be returning money, they've got a certain runway,
Yeah.
particularly if they're not profitable or they're not, able to cover their costs otherwise. But this idea of you are always the other buyer, meaning, right, like if you're at the table, like you can choose to buy your company back, right? And you're the other buyer in those situations, because even if it's an unsolicited offer or you really only have one party at the table, it feels like you're kind of in a bind. But the more that you can set this up as being, well, no, I can continue to operate the company, the stronger position you're going to be in.
Yeah.
Like I said, obviously in some of these kind of startup cases where, they're running out of cash and they need cash to survive.
Yeah.
But how do you help? Like, what are some things that you've seen founders do that help them not feel so desperate or not feel so, I don't really have an option here in these situations?
Well, plan ahead, right? Like you said, have that, what's the BATNA? Best alternative to
best alternative to negotiating agreement.
Yeah, have that BATNA. Don't wait till you've got 3 months of runway left. That's the worst time to do this. As soon as you raise like I said, keep those conversations open. As soon as you raise your Series B or Series C, start those conversations, so that you're not just beholden to this group of investors or this buyer that's come in at the last minute. Plan ahead.
Yeah. What else have you seen? Actually, I'm kind of curious on the retrade kind of trend that you've seen. Like, what do you think is driving this retrade? I mean, are buyers just bullish and they realize they can push, sellers around? And is this just become a strategy for them?
I hope to think so. I don't want to live in a world where, they're doing this with premeditated. I think it's, I think they're just being extra bullish at the beginning. Okay. I am an optimist. I don't want to think the world is, that conniving. But I think there's strategies, there's things we can do at the term sheet stage to protect you in those sorts of situations. It's unusual to have like a termination fee in private company transactions, and those termination fees only usually kick in once the agreement is signed and the agreement terminates between signing and closing. But in most private company transactions, it's the act of actually getting to signing that's difficult, not between signing and closing. There's very little risk that the deal doesn't actually close. But there's things we can do at the term sheet stage to at least cover.
Are you seeing kill fees associated with term sheets or with actual?
That's what I mean. We can get a little creative with that. It's not, I like to call them like prepayment fees or something like that. They'll put in $250K right now to prepay, and then that gets credited at closing. If they walk away, then they don't get it back, and at least that covers your transaction expenses and your efforts for the last 6 weeks. And you're ignoring your business and you're ignoring your customers.
Exactly.
Yeah.
That's one of the biggest risks I've seen is, founders take their eye off the ball and now they're dealing with a down quarter and we're trying to put lipstick on a pig and trying to close it. Right. It's just, if you're not continuing to focus on performing your company, it can be a problem. Yeah. In terms of, another thing that I typically do with founders is we try to create the list of all the reasons why you shouldn't or you don't want to buy my company, or all the skeletons I have in my closet, and get that out up front just so that you don't run into the situation where, okay, like now I'm in diligence and something comes up and now I'm at risk because they say, okay, well, we got to knock 10% off the price because we didn't know that X, Y, and Z. Get all that stuff on the table up front, take away all of their arguments they could have for a reducing price early so that you don't get into the situation, during diligence.
In my experience, founders don't know those things, right? If they did, they would have taken care of it themselves. They don't know it unless they've gone through one failed M&A. Then to the second, the next buyer that they go to, certainly, and I've done that a couple times, where we'll approach them and we'll tell them right away that deal fell apart because of export control issues or whatever it was.
Yeah, exactly. We have client concentration, or we've got an issue with this IP or something. How do you run like mock due diligence with companies and stuff like that? Because it seems like almost like throw them through the gym once, get all those things on the table, fix it before we actually do it for
but who
real.
has the budget for that, right? Unless there's a buyer coming
We
in.
need to figure out a weekend. We'll create a due diligence weekend where we can take leadership teams away,
Yeah.
run them through the ringer and see what comes up.
Yeah. No, it's the documents. It's not, I mean, yes, there is that grueling due diligence call where, 50 lawyers from the buyer will get on the call and you've got one little CEO and me. And, but it's fine. Like those are what it is. Those aren't a big deal. It's the actual, it's the unknown. It's what they're going to find in your documents that you don't, and that can't be addressed over a weekend.
Are there a couple of things that typically come up or things that have come up that you'd tell founders, hey, think about this before you get too far or prepare for something like this?
No, because usually nothing that can't be fixed, right? Usually it's something to do with the IP assignments not being done properly or some equity issuances not being done properly. But those are things that can be fixed in diligence. Larger regulatory issues are hard to control for.
Yeah, kind of environmental kind of issues.
Yeah.
Interesting. What other advice would you have for founders that are kind of earlier stage, things that you'd say they could think about or just general philosophies that will help them when they approach more of a transaction mode?
I think learn to be a better negotiator. Yeah, that's one I think I overlooked when I was a younger lawyer, how important that is. And as I get older and I see founders who are just calmer with whether it's the investors that they're with or a potential M&A buyer. Yeah, there's a lot of those softer skills that can get you far.
Yeah. And it is always hard because as a founder, you may do 2, 3, 4 of these if you're really lucky, but the other side is doing them 3 times a week. So that's the difficult part. That's why I tell founders it's really hard. At the term sheet stage is when you have the most leverage. Get what you can get. Yeah. Thank you so much. This has been great, Mital. If people want to find out more about you, about the work that you do, what's the best way to get that information?
Sure. At our law firm website, www.grellas.com. That's GRELLAS. And you can find me online anywhere, Mital Makadia, and be happy to chat.
Perfect. I'll make sure all the information's in show notes. Thank you so much for taking the time today.
Yeah. Thank you.